Welcome to Market Monday from the investment team and the trust department at the First National Bank. We have a lot of consequential data points coming over the next couple of weeks that will help determine what happens with equity prices as proxied by the S&P 500 and interest rates. We'll go through all of that stuff in that order and close with a little bit of history, which informs why we have the views on the economy that we have. So going forward, we're expecting basically sentiment information. Factory orders, durable goods show information about consumer demand. Both of those are expected to show pretty significant drops, in the survey. However, we've been seeing a lot of stronger than expected data, so it would not be a big surprise for these numbers to come in less bad than what the expectation is here. It's reflected as a 2.9% decline in factory orders or a 6.1% decline in durables. We see labor market information, and the labor market has been exceedingly strong, and we'll talk about that as we get into the economy piece at the end, where we're talking about the context. But labor market remains very robust, and that's a problem if the Federal Reserve is actually trying to get to a point where they can cut rates, as everyone wants them to do, or seems to want them to do by the end of the year. Right now, the situation looks pretty untenable with regard to that. Anyway, we get ballots of trade, we get more labor market info, we get the more labor market info, and this one right here, the change in non-farm payrolls, this is the one that we're really watching, and it's been coming in consistently at levels that are at least 1.5 to 2 times the expectations. So we would not be surprised to see this 200,000 get blown away and some stronger number come out. With that said, if the number did surprise to the downside and say, hey, there's a lot less jobs being created all of a sudden, that might be a bit dovish toward what the Fed has to do and the rate situation in general. So we will be keenly watching that, but our expectation is this number is probably low. It's been low the past 5 or so times that it's printed. We get unemployment at 3.7%. That's the expectation. That's about where it is now. That is a historically low level of unemployment, and it's unsustainable over the long term. To put that into perspective, in school, economics professors typically cite 5% as the long-term sustainable unemployment rate for an economy that's at full capacity. So we are actually running above capacity, which is an inflationary pressure on the economy. We'll get consumer price index information and we get producer price information. This gives us an insight into corporate margins, by the way. Talk about that in a little bit. We'll round things out with more information. We get real estate, and the big whopper here is the Federal Open Market Committee's rate decision, which is expected to be flat. Keep in mind, only a few months ago, they were talking, and when I say they, I mean the financial media, about a March rate cut. In fact, now you're seeing some of the talking heads at the larger hedge funds and some of the personalities, investment professionals that get on to CNBC start to talk about potentially the Fed is going to be unable to cut rates and perhaps even be in a position where they have to hike before the end of the year as opposed to cutting. So it's interesting to see what plays out here, and all eyes are going to be on the statement that gets released with this. It's a widespread expectation they'll do nothing here, and we're not expecting them to hike rates or cut rates at this meeting. However, we are expecting some language to show up in that press release that suggests a hawkish move by the Fed to be more concerned with inflation than they are problems in the economy. And if and when that happens, we may see equity market prices sell off a little bit on that news, and we may see bonds sell off on that news, raising interest rates a little bit higher in the expectation that the Fed may have to resume its hiking cycle instead of cutting. We'll end things out with more sentiment and more real estate market information. So the S&P 500 continues to march higher, the market is essentially shrugging off any bad news, and it continues to go higher. Whenever there's good news, it moves up, and it really doesn't fall when there's bad news, which is characteristic of a bull market. We see no sign of that abating anytime soon, so we're going to continue to watch it. But for now, the market is telling us that it wants to go up. And when we look at the volatility index, the VIX, volatility is falling again. to a very low, historically low level. We didn't zoom out on the higher time frame with this over decades, but this is a pretty low level for the volatility index to be at, and it indicates placid markets are the expected outcome over the next month or so. When we get the CPI number, the consumer price index number, and this is part of the whole corporate margins thing that got highlighted in the economic data portion, and we're going to talk about now. So consumer prices were rising by about 3.1% on a year-over-year basis as of the last reading, and we're going to get more information on that again at this next meeting, or at this next release here over the next couple of weeks. And consumer prices rising by 3.1% in the context of producer prices falling by 1.1% means that corporate margins are improving, particularly in light of the strong consumer who keeps buying things, showing higher than expected levels of demand in the economy. So when a corporation is valued by investment professionals, generally we're looking at future cash flows and we're going to discount them and back to the current value, and that's the value of a share of stock. And if you have a company that is, having lower input costs as proxied by the producer price index that we're looking at here, and they're able to sell for higher prices, which they're, proxied by the consumer price index over here, that means the margin on every unit sold is increasing. And we have a strong demand situation, which means sales are going to keep up. So if we hold sales constant and we show increasing margins, that's a positive for stock prices and could very well be the catalyst that's driving markets higher. Nobody actually knows. That's just a hypothesis, but that's the one we're going with. In terms of interest rates, the Treasury curve has shifted higher over the past couple of weeks, but not in a meaningful way, and that indicates the market adjusting to this idea that rates are going to remain stable for longer. Potentially there are no rate cuts, and potentially even maybe the Fed has to hike rates instead of lower rates. And it also gives us an idea what inflation expectations are. So 4.22 on the 10-year yield says, that basically anywhere from 3.5% or so to 4% is where they're expecting, the inflation rate to be, because inflation is a component of pricing the yield that's required to hold Treasury bonds. And does that filter into the corporate bond world? Yes, it does. And that has shifted a tiny bit higher as well. And current yields of 4.81 in the 5-year, 5% and an eighth in the 10-year paper are really good for fixed income investors, and it's also good for balanced account investors who hold a portfolio of stocks and bonds, with the idea that the bonds are going to provide a lower level of volatility and some current income. You're not getting paid to reduce volatility in your portfolio as a total return investor that has, multiple asset classes. So this is a good situation. In terms of history, we have the annual GDP at 2.5% as of the last reading, and we're going to get another reading of that coming out this month, a revision to that. What's happening with GDP at 2.5% versus the 2% that has been typical or is cited as what is the long-term sustainable rate of growth for an advanced economy. That says it's still running a little bit hotter than average, although that's come down dramatically from the nearly 6% it was recently. Is it sustainable? Probably here. And it is turning up again. It is not heading down, which kind of puts a hole in the case that we're going to see a meaningful recession anytime soon. Unless the Fed, of course, starts jacking rates up again, which they may be forced to do. When we look at the labor market, we want to highlight this because these numbers are coming in very strong. Last time it came in at 353,000 when the expectation was only for about 180. So almost double what the market was expecting. And it's trending up right here from back in September when it hit its low, still at a high level historically. And if we look, where we're at now is in the higher level of history that goes back all the way to the 1930s. So that's a strong labor market, that's an inflationary pressure, and that is not indicative of a slowdown in the economy that the Fed wants to see. And let's talk about labor productivity, because the big story lately has been about artificial intelligence and what its impact is going to be. And we think some of the computing power, including artificial intelligence and machine learning models, and just the tools that are available to workers today in any industry really, has improved productivity. We were at a level down in 2022 that was productivity was declining at a rapid rate, whereas now it's moved up toward the higher middle of its range that goes all the way back to the 1940s, and we expect this to continue to go up. Productivity is a driving force, and it does suggest that economic growth can be somewhat sustainable, because if productivity is increasing in tandem with a strong labor market, that means that results are probably going to be increasing as well, at least in the nearer to midterm. Where that ends, nobody knows. And again, to that point, let's zoom out like we always do and close this thing off and look at 20 years, because this market's been doing nothing but going up and everybody's got the fear of missing out. That's not really the right way to approach things, in our opinion. You don't want to be feeling emotional about your portfolio. You want to use logic and a long-term, well laid out plan, because the market goes up, it goes down, you see these valleys, you see these peaks, and generally everyone's terrified down here and everybody's all excited up here. And so what we want is more of an even keel, stick to a disciplined long-term plan. We're happy to discuss how to build one, or how to keep you on your already developed one here. If you have concerns about your plan, if you have concerns about markets or the economy, feel free to reach out. We'd love to chat with you. Hope you found this video informative. Thanks, and have a great day.